Leaders and financial institutions. Market participants are assessing how these political and trade developments might influence corporate earnings and overall economic growth. The volatility underscores the sensitivity of financial markets to both domestic political narratives and global trade dynamics. This period of uncertainty highlights the interconnectedness of political decisions and economic performance.
United States construction spending figures, released for July 1st. New data provides insights into the current state of the nation's construction sector. The United States Census Bureau has released its latest figures on construction spending, with the data made public on July 1st, 2025. This report offers a timely snapshot of activity within the vital construction sector, a key indicator of overall economic health. The statistics cover various segments of construction, including residential, non-residential, and public projects. Analysts will be scrutinizing these numbers to gauge investment trends and future growth prospects in the industry. Construction spending is often seen as a forward-looking economic indicator, as it reflects confidence in future demand and economic stability. The report details the value of construction put in place, providing a comprehensive overview of expenditures. Fluctuations in construction spending can signal shifts in employment, material demand, and broader economic momentum. This release is particularly important for policymakers and businesses making investment decisions. Understanding these trends helps in forecasting economic performance and identifying areas of strength or weakness within the national economy.
Federal Reserve Chair Powell stresses non-political role amidst rate cut discussions. The head of the central bank reiterates the institution's independence as pressure mounts regarding future interest rate decisions. Federal Reserve Chair Jerome Powell has reportedly emphasized the central bank's commitment to remaining non-political, a statement made amidst increasing pressure from figures like former President Donald Trump. This assertion underscores the Federal Reserve's dedication to its dual mandate of maximizing employment and maintaining price stability independent of political influence. Speculation about potential interest rate cuts continues to circulate, with Powell indicating that such a move has not been ruled out. The Federal Reserve's monetary policy decisions are critical for the United States economy, directly impacting borrowing costs, inflation, and investment. The central bank carefully monitors a wide array of economic indicators, including inflation rates and labor market data, to inform its policy stance. Maintaining independence from political pressures is considered crucial for the Federal Reserve's credibility and its ability to make sound economic judgments. The ongoing dialogue surrounding interest rates reflects the delicate balance the Federal Reserve must strike to support economic growth without triggering excessive inflation.
United States job openings and labor turnover survey published. The latest JOLTS report offers a fresh perspective on the dynamics of the American labor market. The Bureau of Labor Statistics has released its Job Openings and Labor Turnover Survey, commonly known as JOLTS, on July 1, 2025. This crucial economic report provides detailed information on job vacancies, hires, and separations across various industries in the United States. The JOLTS data is a key indicator for understanding labor market tightness and the overall health of the economy. Economists closely analyze these figures to assess employer demand for labor and the willingness of workers to change jobs. A high number of job openings typically suggests a robust labor market, while increased quits can indicate worker confidence in finding new employment. The report also sheds light on layoff rates, which are important for gauging economic stability. These statistics are vital for the Federal Reserve in its monetary policy decisions, as labor market conditions significantly influence inflation and economic growth. The data helps to paint a comprehensive picture of the supply and demand balance within the national workforce. The European Union's ambition to tie its development aid will undermine economic development. European Commission seeks to link aid to domestic priorities, raising concerns about effectiveness and credibility. The European Union is reportedly preparing to make its development spending more directly conditional on its own internal priorities. Recent reports indicate that the European Commission aims to extract greater strategic value from the financial assistance it provides to low-income countries. This could involve making funding contingent on measures such as controlling migration or favoring European industries. Such a move would represent a significant departure from the European Union's current model, where aid is largely provided without specific conditions. The Commission argues that this new approach, which some liken to an America First foreign policy, would make aid more politically justifiable. However, critics contend that this strategy risks undermining the fundamental goals of development and could damage the European Union's credibility as a reliable partner. Evidence suggests that tied aid, which requires recipients to spend funds on goods or services from the donor country, is generally ineffective. This practice can stifle economic growth and hinder the long-term self-reliance of lower-income nations, ultimately reducing the overall return on investment for the European economy in the longer term.
European Central Bank signals potential pause in interest rate cuts. Following a recent reduction, the central bank indicates a possible halt in further cuts to assess economic impact. The European Central Bank recently implemented a reduction of 25 basis points in its key interest rates during its June meeting. This decision was made based on updated projections for inflation and overall economic growth within the euro area. Following this adjustment, President Christine Lagarde indicated that the central bank is nearing the conclusion of its current easing cycle. This suggests that a pause in further interest rate reductions might be on the horizon, potentially occurring after the summer period. The central bank aims to reassess the economic situation, particularly to gauge the full impact of new United States tariffs on the Eurozone economy and inflation. Additionally, the European Central Bank's updated staff projections will play a crucial role in future policy decisions. The benchmark interest rate in the euro area was last recorded at 2.15%. This strategic pause would allow policymakers to observe how the economy responds to the recent rate cut and evolving global trade dynamics, ensuring a measured approach to monetary policy. Varied economic sentiment reported across key European nations in June. Business and consumer confidence surveys revealed diverging trends within the euro area. Economic sentiment in several major European economies presented a mixed picture during June. Latvia's economic sentiment reached its highest point since February 2022, indicating growing confidence in the Baltic state. Similarly, Lithuania also experienced an increase in its economic sentiment index. However, the situation was less optimistic in some of the larger economies. France saw a deterioration in its economic sentiment, suggesting a decline in confidence among businesses and consumers. Germany, the largest economy in the euro area, also reported a more downbeat economic sentiment for the month of June. These sentiment indicators are important as they often foreshadow future economic activity, including investment and consumer spending. The divergence highlights the varied recovery paths and challenges faced by individual member states within the broader European Union. Policymakers will be closely observing these trends to tailor appropriate responses.
Euro area economic growth continues slowly amidst global trade concerns. First quarter gross domestic product figures confirm modest expansion, with future outlook tempered by external factors. The euro area economy expanded by 0.6% in the first quarter of 2025, showing a notable acceleration compared to the previous quarter's growth. This positive momentum was largely supported by strong performances in key member states, including Spain and Germany, which recorded increases of 0.6% and 0.4% respectively. Italy also contributed to this expansion, with a 0.3% rise in its economic output. Despite these encouraging initial figures, the broader economic outlook for the remainder of 2025 remains cautious. Projections indicate that the pace of growth is likely to moderate in the coming quarters. This anticipated slowdown is primarily attributed to heightened uncertainty surrounding global trade policies. The potential for increased protectionism, particularly from the United States, poses a significant challenge for the euro area's export-driven economies. Such external pressures could negatively impact business confidence and investment decisions across the region, making the path to sustained recovery more complex.
Euro area inflation nears target.